We're going to calculate the stock price for Valero Energy, VLO. And let's get the market cap, 27.17 billion. Stock price 66.64. And if you take the market cap divided by the stock price, you get 408 million. That's the number of shares outstanding. Next is free cash flow. And the best way to calculate the stock price for a company is to estimate future free cash flow and then discount that number back to today's value. And that's what we're doing in this video. So we got 4 years free cash flow on a cash flow statement. Then we need net income on the income statement. And all this information is in Yahoo Finance. You could also go to the 10K, but it's just so convenient using Yahoo. Revenue. And as I pull these numbers, I kind of take a glance on how they move over time. It's definitely something you want to get used to doing. Even if you use a model, just look at the numbers. Don't just plug into the model and get a result. Because you can see revenue is increasing at a nice rate, although in 2019 it did decrease. This is an energy company. I'm not sure why it decreased in 2019. I would think it will decrease this year because of the price of oil has dropped so dramatically, and this company will probably take a hit in revenue. But let's move on. Now we need to look at the capital structure of Valero and figure out the discount rate we need to apply to future cash flows. The interest expense is 450 million. That's the interest they pay on their debt. Let's go to the balance sheet to see how much debt they have. We'll go to the liabilities section. Current debt is $500 million. And let's see, non-current debt, long-term debt is $9 billion. So the interest on the debt is 4.7%. That's a decent interest rate. Now, interest payments are tax deductible, so let's get the tax rate. Go back to the income statement. Income before tax, $3.5 billion. Income tax, $700 million. It's a 20% tax rate. So the cost of debt is 3.75%. 26% of the capital structure of this company is debt. Also, something I like to look at is how much debt they have in relation to their entire company. Because Apple can have, if Apple had $9 billion of debt, it would be like 0.01% of their company. So it wouldn't affect them. But this company, $9 billion is 26%. So you have to look at it in relation to the entire company. 26% is okay. It's not the greatest, but it's okay. Obviously you want lower the better when it comes to debt. Let's get the cost of equity. The beta is kind of high, 1.97, so that means the stock price moves twice as much as the market. So the higher the beta, the higher the cost of equity. And we calculate cost of equity using the CAPM model, capital asset pricing model. It's a pretty simple calculation. Now, the reason equity, 17%, is so much higher than debt, 4%, because it's more risky. Equity sits lower in the capital structure of a company. So in the event of a default, debt holders are paid before equity holders. And when there's a default, equity holders tend to get nothing. So that's why they require a greater return, because of the greater risk involved. So we calculated the WACC, the weighted average cost of capital, 13.85%. That's just a blend of the cost of debt and cost of equity. And this is the discount rate this company uses when it takes on new projects. It needs to get over this hurdle to add value to its investors. And this is what we're going to discount the future cash flows by. So we calculated the future cash flows based off of the inputs we put in earlier. So we did 4 years of future free cash flow. Then we did a terminal value, which is all the years beyond year 4. And a terminal value is the same as the Gordon growth model or the dividend discount model. So you could Google those terms and see what the calculation is. We discounted those numbers back to today. And and we get a value of $39 billion for the company. When you divide it by 408 million shares, that's a calculated stock price of $95. It's trading at 67, so it's trading at a 30% discount, so we consider this a buy. And it looks like it was trading at intrinsic value, even as early as like January, February. But it dropped like everything else. It came back up. But you have to look, just because the past financials indicate a value of $95 doesn't mean it's worth $95. You have to kind of get a sense of what is the future of the company. Is it going to still be able to have the same amount of revenue even though oil prices are so low? And stocks can always trade higher or lower than intrinsic value. Intrinsic value is meaningless to a lot of people. The stock moves based off of the market demand. If more people want to buy a stock, the price gets bid up. It keeps getting bid higher and higher and higher. If more people are looking to sell a stock, it keeps getting pushed down lower and lower and lower until equilibrium is hit. And everyone has their own opinion on a stock. This is my model, and it's my opinion. So thanks for watching.